All right. Today we're going to learn about closing entries. But before we start closing entries, I always start back at the beginning, which is the accounting equation. Everything starts with the accounting equation. So here I have the accounting equation um, written along with the normal balances in a T-chart, reminding you that the left side is always debit, the right side is always credit. In this section, I have the owner's equity accounts in a T-chart as well. Here, the left side is also debit and the right side is also credit. So in chapter 8 of the Southwest 10th edition textbook, we learn about closing entries. So the first thing we're going to learn about is the word closing. The word closing means to set an account to zero. So the whole point of this chapter is that we're going to set certain accounts to a zero balance. Zero balance. Now, we're going to move to a new way of organizing our accounts. So if you turn in your textbook to the first page of 8-1, you will see a section that talks about a new way of organizing our accounts. So we started organizing our accounts by putting them in the account equation. Then we started organizing our accounts when we look at our chart of accounts, which is on page 3 in our textbook, by putting them in a category of financial statements, income statement versus balance sheet. Now we have a new way of organizing our accounts, and that is separating them between temporary accounts and permanent accounts. Accounts are either temporary or permanent. Temporary or permanent. Temporary accounts are the accounts that close. Permanent accounts never close. So we have temporary accounts, we're going to close those, and permanent accounts, they stay open. So the next question you may have is, what are our temporary accounts? Temporary accounts are these accounts: sales, expenses, sales expenses, drawing, sales expenses drawing, and then income summary. Income summary, not to get confused between income statement. That is not the same thing. Income summary is an account. Income statement is a report. So then we have our permanent accounts. So you're like, what are the permanent accounts? All accounts that are not sales, expenses, drawing, and income summary. All right. So now we have our accounts divided. We have our temporary accounts and then we have our permanent accounts. So temporary accounts are the accounts that we're going to close. I want to take a moment to draw something to your attention. Look at our temporary accounts. Some of them are also our owner's equity accounts. Sales is an owner's equity account. Expenses, owner's equity account. Drawing, owner's equity account. So that lets you know that most of the accounts that we are closing are part of owner's equity. Normally, if this was live, I would say, are there any questions at this time? Okay, so now that we know the accounts that we're going to close, the next thing I need for you to know is that the order of closing these accounts is important. So we're going to review that closing accounts means to set an account to zero. So you may be thinking, how do I do this? If this was live, I would ask you, what is the word or what does the word normal balance mean? That's what I ask my students. Normal balance. What does it mean? What does it mean? Normal balance is how an account is increased. How an account is increased. So we know we must close accounts. We know that closing accounts means setting an account to zero. And now we are reminded that the word normal balance means how an account is increased. So to know how to close an account, set it to zero, we must know the normal balance of accounts. Because to increase an account means to apply the normal balance. So the opposite is true. To decrease an account, we must apply the opposite of the normal balance. Okay. So with that being said, we're going to talk about the order that we close accounts. The first account we close is sales. Okay. And the normal balance of sales is credit. So the idea would be we would debit the sales account in order to set it to zero. Then after we close sales, we close expense accounts. The normal balance of expense accounts is debit. So if we're going to close the expense accounts, we would credit all of the expense accounts. Notice I said all. We debit all the expense accounts are debit, and we have many expense accounts. So in order to close them, we would credit each expense account. Then we will close the income summary. The income summary has no normal balance, and we'll come back to that. And then the last account we close is drawing. And the normal balance of drawing is debit. So when we close the drawing account, we must credit the drawing account. Hey, are you okay? Okay, so now we're going to talk about the income summary account. I've already told you that the income summary account has no balance, no normal balance. The other thing I need to tell you about the income summary account is that the only purpose it serves is to close accounts. So what I mean by that is when we write a journal entry, we already know that journal entries must have a minimum of two accounts. There must always be a debit and there must always be a credit. So when we're closing our accounts, the income summary account serves as the other half of that account. We use the income summary to close the sales and expense accounts. Okay? And this would also be a moment when I would ask for questions if I was teaching a live class. All right, so let's get down to the nitty gritty. Now that we have all of that background information, let's get to closing some accounts. All right, so we need to remember that closing accounts is a part of the accounting cycle. This is step 8 of the accounting cycle. Okay, so when we created our worksheet that we did before we produced financial statements, we laid out all the details. Then we produced financial statements. Then we said we're done. And now we got to get ready for next month. So part of getting ready for next month is closing these accounts so we can start all over. And what accounts do we close? Temporary accounts. So which one is first? That's correct. You're right. It is the sales account. So first we close sales. What is the normal balance of sales? What? Yes, credit. You are so smart. Credit. So we will debit the sales account and credit the income summary account. Boom. Sales account is closed. What do we close second? That would be the expense account. That is correct. Ah, y'all are so smart. What is the normal balance of the expense account? You said it. It is debit. Debit is the normal balance of expense account. So we know we always debit first when we write journal entries. So in this case, we would debit the income summary for the total amount of the expense accounts. And then we would credit each expense account. But there would only be one income summary. So it's one debit and many credits because we are debiting the income summary for the total amount of the expense accounts, but we're doing a credit line for each expense account that we have. Advertising expense. Why did my mind just go blank? I don't know. Look at your list of expense accounts. You'll be able to help me out. But any expense account that has an amount, you would list it as a credit. Okay? And that is the second account that we close. Next, we would do the income summary account. I'm pausing because I'm wondering if I have enough space, but we're going to go for it, okay? All right, so remember I told you the income summary account has no normal balance, okay? So when we close the income summary, what we're actually doing is that we're going to close out our net income or our net loss to the capital account, okay? So when we close the income summary, we're closing either our net income or net loss to the capital account. Because if we look here, we see here we close sales and we close it to the income summary. And then we close our expenses and we close it to the income summary. And if we remember from our past lessons, sales minus expenses gives us net income or net loss. So in other words, we have placed net income or net loss into the income summary account. So when we close this account, we're placing that net income or net loss into the capital account. So the journal entry would look like this. If, you know, so let's say we had net income. So if we had net income, that means that we had more sales than expenses. So that means that the final balance in the income summary would be a credit because sales close out to credit. And if we had more sales than expenses, the income summary balance is credit. So okay. So the net income has a, I'm sorry, if we have net income, the balance of the income summary, final balance would be credit. So how does that journal entry look? It looks like this. We would debit income summary and credit capital. And if you remember our owner's equity section with our accounting equation, the normal balance of capital is credit. So for us to credit capital, that means we're increasing capital, which means we've made profit, we've made money, so the owner would have more capital. But then the opposite is true. If we have a net loss means that we have more expenses than sales. And if we have more expenses than sales, that means we lost money. So that means that it would be a debit balance for the income summary. So in order to close it, we would credit income summary and then debit capital. We always debit first whenever we do journal entries. So to close the income summary in the case of a net loss, we would debit capital and we would credit income summary. Okay, so that is the third account we close. And then the fourth account is the drawing account. Which we know has a normal debit balance. And in order to close it, we need to credit drawing And this time we debit capital because we will recall that we only use the drawing account when the owner takes money out of the company for personal use. So we want to reset this account every month to keep track of the money the owner's taking out for personal use. So we would debit capital, which reduces the value of capital, which makes sense because the owner has literally taken cash out of the company, which reduces the owner's value in the company. And credit drawing. And once we complete all of these journal entries, we are ready to move on to the next step, which is step 9. But this is how we close all of our accounts.